this is from Adonis. Is it logical to use trailing stop orders for all trades when the trader is busy at work and doesn't have time to monitor and follow the trades?
Yeah, you could.
Explain what a trailing stop is and maybe give an overview on different types of orders. Maybe there's some people that think you can only buy and sell and that's it.
Yeah, so a trailing stop means that as a stock moves in your direction, your stop loss will move up with it. But once the stock goes in the opposite direction, your stop loss stays. Let's say, for example, you buy a stock at $10 and you have a trailing stop loss at $9.50. When the stock goes up to $10.01, your stop loss will move up to $9.51. Then the stock goes up to $10.50. Your stop loss moves up to $10. But when the stock drops to $10.20, your stop loss stays at $10. Okay, so it's like you will maintain a distance between your stop and your entry of a maximum distance of, let's say, those 50 cents, like the $10 to $9.50. Your stop loss will never be more than 50 cents away from the price of the stock until you get stopped out. So the concept there is that as long as the stock is continuing higher, your stop loss will just move up with it until the stock pulls back, and then you get stopped out and you're out of the trade. I don't mind using trailing stop losses if you're really busy at work. What I would say is that if you are able to kind of manage your positions, I would say to avoid using trailing stops in the very beginning of your trade, because if you enter a trade during a period of consolidation, you run the risk of getting stopped out on the trailing stop if your trailing stop is too tight. Because like I said, the stock, let's say if a stock is trading in between 10 and 10.50, and that's like a consolidation, right? If you buy the stock at 10.15 and your stop loss is, let's say, 9.75, I'm just making up a number, and it goes up to 10.40, that's going to pull your stop loss now up into the consolidation zone. So if the stock doesn't break out at that moment, and let's say it pulls back to 10.15, 10.10, you're going to get stopped out with your trailing stop, because your trailing stop will be too tight, because as it moves higher, depending on the range of the consolidation. So let's say here's the consolidation, right? And then here's your entry, and then here's your stop loss. As the stock moves higher, it's going to pull your stop loss into the consolidation zone, and then you might get stopped out and the stock might continue higher. So if you're going to use the trailing stop losses, just make sure you give yourself a little bit of room depending on the consolidation that you're entering your trade.